Welcome back to Business Brainrot, where we make complex financial topics simple and actionable. Today, we're tackling one of the most exciting yet intimidating topics out there: how to become rich from the stock market. Now, let's be clear, getting rich through stocks isn't about luck or gambling. It's about strategy, patience, and discipline. In this video, I'll walk you through a framework to grow your wealth, avoid common mistakes, and set yourself up for long-term success. Let's get started. First, let's demystify the stock market. At its core, the stock market is a place where people buy and sell shares of companies. When you buy a stock, you're essentially buying a tiny piece of that company. If the company grows and makes more money, the value of your shares typically goes up. If the company struggles, the value can go down. Sounds simple, right? But here's where it gets interesting. The stock market is driven by two things: value and sentiment. Value comes from a company's performance, its profits, growth, and innovation. Sentiment is how investors feel about the company or the market as a whole. This mix creates opportunities for wealth, but it also comes with risks. To get rich, you need to understand that the stock market isn't a slot machine. It's a long-term wealth-building tool. Historically, the stock market has delivered an average annual return of about 7 to 10% after inflation, according to data from the S&P 500. That means if you invest smartly and stay consistent, your money can double roughly every 7 to 10 years. But to make that happen, you need a plan. Before you even think about buying your first stock, you need a solid financial foundation. Think of it like building a house. You wouldn't start without a strong base, right? Here are the 3 things you need to do first. First, create an emergency fund. Set aside 3 to 6 months' worth of living expenses in a savings account. Why? Because the stock market can be unpredictable in the short term. If an emergency hits and you've got no cash, you might have to sell your investments at a loss. An emergency fund protects you from that. Second, pay off high-interest debt. If you've got credit card debt with 15 to 20% interest, paying it off is like earning a guaranteed return of that amount. Compare that to the stock market's average 7 to 10% return. It's a no-brainer. Clear those debts before you invest. And third, set a budget and investment goal. Know how much you can afford to invest each month. Even if it's just $100, consistency matters more than the amount. Use a budgeting app to track your income and expenses, and set a clear goal, like investing for retirement, a house, or financial independence. Let's say you can invest $500 a month. With a 7% annual return in 30 years, that could grow to over $600,000 thanks to the power of compounding. That's the magic of starting early and staying consistent. Now that your finances are in order, it's time to learn how the stock market works. You don't need a finance degree, but you do need to understand a few key concepts. First, types of investments. There are different ways to invest in the stock market: individual stocks, exchange-traded funds, and mutual funds. Individual stocks are riskier because you're betting on one company. ETFs and mutual funds spread your money across many companies, reducing risk. For beginners, I recommend starting with ETFs like those tracking the S&P 500. It's like owning a slice of the top 500 companies in the US. Second, risk and diversification. Diversification is your safety net. By spreading your investments across different industries like tech, healthcare, and consumer goods, you reduce the chance of losing everything if one sector tanks. A simple rule: never put more than 5% of your portfolio in a single stock. Third, learn to read financials. Before buying a stock, check the company's financial health. Look at its revenue growth, profit margins, and debt levels. You can find this info in the company's annual report or on sites like Yahoo Finance or Morningstar. Also, pay attention to the price-to-earnings ratio. It tells you if a stock is overvalued or undervalued compared to its earnings. Don't worry if this feels overwhelming at first. Start with free resources like Investopedia, YouTube channels, or books like The Intelligent Investor by Benjamin Graham. Knowledge is power in the stock market. There's no one-size-fits-all strategy for getting rich in the stock market. Your approach depends on your goals, risk tolerance, and time horizon. Here are 3 proven strategies to consider. First, long-term investing. This is the simplest and most effective strategy for most people. You buy high-quality stocks or ETFs and hold them for years, letting them grow through market ups and downs. Companies like Apple, Microsoft, or an S&P 500 ETF are great choices. The key? Patience. The market will dip, but historically it always recovers over time. Second, dividend investing. Some companies pay dividends, a portion of their profits, to shareholders. By investing in dividend-paying stocks, you get regular cash payments, which you can reinvest to grow your wealth faster. Look for companies with a history of consistent dividend growth, like Coca-Cola or Johnson & Johnson. Third, growth investing. If you're willing to take more risk, growth investing focuses on companies with high potential for future growth, like tech startups. These stocks may not pay dividends, but their value can skyrocket if the company succeeds. Be cautious, growth stocks can be volatile. For most people, a mix of these strategies works best. For example, you might put 70% of your portfolio in a low-cost S&P 500 ETF for stability, 20% in dividend stocks for income, and 10% in growth stocks for higher returns. The key is to stick to your strategy and avoid chasing hot trends. The stock market can be an emotional roller coaster. Prices will go up and down, and it's easy to panic or get greedy. Here's how to stay in control. First, ignore short-term noise. Daily market swings are normal. Focus on the long term, 5, 10, or 20 years out. If you're invested in solid companies or ETFs, temporary dips won't derail your wealth building. Second, don't follow the crowd. When everyone's talking about a hot stock, it's often overpriced. Do your own research and stick to your plan. Remember the dot-com bubble or the GameStop frenzy? Many who chased those trends lost big. Third, rebalance your portfolio. Check your investments once or twice a year to make sure they align with your goals. If one stock or sector grows too much, sell some to rebalance your portfolio and maintain diversification. The biggest risk isn't the market, it's your own emotions. Stay disciplined and don't let fear or excitement drive your decisions. Here's the secret sauce to getting rich in the stock market. Compounding. When your investments earn returns, those returns start earning returns of their own. Over time, this creates exponential growth. Let's break it down. If you invest $10,000 at a 7% annual return, in 10 years, it grows to about $19,700. In 20 years, it's $38,700. In 30 years, over $76,000. And that's without adding a single extra dollar. If you keep investing monthly, the numbers get even crazier. The earlier you start, the more time compounding has to work its magic. A 25-year-old investing $200 a month could have over $1 million by age 65, assuming a 7% return. Start at 35 and you'd need to invest twice as much to hit the same goal. Time is your biggest asset. Before we wrap up, let's talk about the pitfalls that can derail your journey to wealth. First, chasing hot tips. That stock tip from your friend or a random post on X. Ignore it. Most hot tips are based on hype, not fundamentals. Second, overtrading. Buying and selling stocks constantly racks up fees and taxes, and it usually leads to worse returns. Stick to your long-term plan. Third, ignoring taxes. Profits from selling stocks are taxable. Hold investments for at least a year to qualify for lower long-term capital gains taxes. Fourth, not having a plan. Without a clear strategy, you're just gambling. Define your goals, risk tolerance, and timeline before you invest a single dollar. Becoming rich from the stock market isn't about getting lucky. It's about building a disciplined, long-term plan and sticking to it. Start with a strong financial foundation, educate yourself, choose a strategy that fits your goals, and let compounding do the heavy lifting. The stock market isn't a get-rich-quick scheme, but with patience and consistency, it can make you wealthy. Anyways, that's all from our side. Thanks for watching, and I'll see you in the next one.